Hi, good evening, everyone. This is Aman Krishnan from Team Taxman, welcoming you all to today's live session on decoding critical input tax credit issues under GST with practical case studies. I would like to start with a brief about Taxman first. We are the leading publisher of tax and corporate laws in India. We maintain the largest and the most accurate online database on income tax, international taxation, GST, company and SEBI law, IBC, FEMA banking and NBFC, competition law, accounts and audit, and Indian acts and rules. Over the years, we have worked strenuously to offer the solutions that will continue to help you grow your practice. Our 6 decades of experience in the domain has helped us to constantly innovate and enhance our services to take the tax practice to new heights. We have also developed the national website of the income tax department, and we maintain it with the help of our tech team and the editorial. I now welcome Ms. Geetika Srivastav, our speaker for the evening. Now, ma'am, has she has an experience of nearly 12 years in the field of indirect taxation. Her expertise lies in advising clients on laws relating to GST, service tax, excise and customs, including FTB. She has also assisted various clients across sections such as ONG, mines and minerals, manufacturing, FMCG, e-com, telecom, etc. We are very pleased to have us with you, ma'am. And now I have some tips for the participants. Firstly, your mic will be on mute. Secondly, you may post your questions in the chat box given on your right hand side. Your questions will be answered by the speaker during the session or after the session by the R&D team. And a copy of the presentation on the subject matter shall be sent to you in email for your future references. Now, without taking any more time, I request Ms. Geetika to address the audience and proceed. Over to you, ma'am.
Thank you, Aman. Thanks for such a nice introduction. Thanks, Team Taxman, for setting up this session. Today's session is actually very, very critical and very commonly discussed issues which every industry is facing. So, before I start with the session, I'll also welcome all the participants who have taken out their valuable time on Friday evening and they are coming and attending this session. With this note, I'll start with my presentation. In today's topic, we have chosen we have taken handpicked topics for the discussion which the industry is facing on day-to-day basis. And yes, there may be answers in yes, there may be answers in no's, and there may be answers in maybe. So maybe situation, depending upon the circumstances and the situation, we'll have to see how the business can work on these aspects, how they can strategize so that they take the maximum benefit with the given law, and also safeguard themselves from any future liability which may occur in case they are not aware of the correct principles of the law. So today we'll cover three crucial issues which every industry is facing today. Although one part of this presentation is very specific to the telecom industry, but trust me, the discussion that will happen in that particular industry will have a impact on the industries across, depending upon the the expenses and the credits that they are taking in day-to-day life. So first we'll discuss upon the ITC eligibilities on immutable property, and very specific to the telecom towers. Very, very critical topic for the day, because this particular industry is actually facing a lot of difficulties in terms of credit. So from there, we'll also draw some ratio how benefits can be taken up by the other industries as well. Second, we'll talk about the gifts versus sales promotion items, whether the manufacturers and all who are dealing with the dealers, distributors, to what extent they can take the credits of any freebies or any gifts or any sales promotion articles that they are giving to the distributors in the chain. To what what is the impact in terms of ITC, what are the risks, and what is the benefits that they can achieve out of it. And last is again a very important segment where certain employee related expenses are incurred by the organizations, and there is a lot of discussions and disputes around the eligibility of the credits which are whether it's available when any expenses are done by the organization for the employees benefit. So to start with, we'll start with ITC on immutable property. See, it's been 4 years since we all have been reading this law, and we all know there is a very specific section under section 17(5) which restricts the ITC in respect of any construction of immutable property or any whether it is used for the further supply of works contract, or whether it is used by the organizations for themselves. So what is being restricted is the ITC in respect of the construction of immovable property, and then there is a specific exclusion to the plant and machineries. So to break it into two parts, anything if it is being I wouldn't say any movable properties or anytime constructed. It is normally the constructions are the word is always related to immovable property. But let's say we'll use a parallel term like erection or commissioning sort of a thing. So anything which is in the nature of movable, no doubt about it, the credit of those goods are available. What is not available is in respect of the immovable property. Now the question comes, if anything which is movable is available, then why is there a specific exclusion to plant and machinery? Because in general terms, we all understand the plant, machinery, equipments, these are all movable. So the only reason why these have been kept out of an exclusion is that there are certain plant and machineries, when they are erected, when they are commissioned, they partake the nature of a immovable property. So in order to grant the benefit to the taxpayers, these have been categorically kept out. Had it been just written as an immovable property, construction immovable property, maybe those plant and machinery which take the color of immovable property, the credits for them would have also been denied. But the law has been kind enough to keep them away from the restriction part, and therefore any plant and machinery which is in the form of immovable property. So again, going back to the basics, any plant and machinery which is movable in nature per se, any which case the credit should be allowed. The exclusion from this definition is in respect of only those plant and machinery which take the color of an immovable property, and therefore they might get caught into this restriction, therefore has been specifically excluded. Now the law has also defined what is the plant and machinery in terms of this particular section. It says the plant and machinery means any apparatus, equipment, any machinery fixed to earth by foundation or structural support that are used for making outward supply of goods or services or both, and includes such foundation and structural supports. So very crucial point, not only the plant and machinery or equipment, etc., which is affixed to the structure or the foundation is excluded from the restriction. Even the foundation and the structure support on which these machineries or equipments are mounted, they have also been given exclusion from the restriction. Therefore, these apparatus, equipments, machinery, along with their foundation and structure support, will also be given the benefit of the ITC in case of any taxpayer is implementing or is getting these constructed or erected in their factories or their business premises. Now, in this exclusion of the plant and machinery, there are other three exclusions. The first one, by nature itself, is an immovable property. No point of mentioning, but maybe by way of abundant cautelar, this has been added that any land, building, on any civil structure is excluded from plant and machinery. By nature, they never qualify as a plant and machinery, but let's say by way of abundant caution, the law has clarified these things, that land, building, etc. will not fall under the exclusion of plant and machinery. Then comes the exclusion B and C, which talks about the telecommunication towers and pipelines laid outside the factory premises. So these items have been specifically kept out of the exclusion so as to include them. So what happens? The exclusion to exclusion means inclusion to the main clause. So ITCs in respect of the telecommunication towers, pipelines laid outside factory has been specifically denied under this particular section. So if you are taking any item, any apparatus, equipment, which is not in the nature of A, B, C, A, of course, it cannot be there, B and C, the credits of these items will not be allowed to any entity. Now, when we look into the meaning of immovable property, nowhere under the GST law this term has been defined, because we have seen the immovable property by its nature, by its connotation itself. We know something which is not movable is an immovable property. Then comes the situation where the plant, machineries, equipments, etc., which may otherwise be movable, but once they are affixed to the earth, embedded to any foundation, they become immovable. But unfortunately, GST law has not spelled down very clearly. So what do we do in such cases? We borrow the definitions from the supporting legislations. So if we see the General Clauses Act, if we see the Transfer Property Act, the immovable property has been defined in a way when it covers land, where it also covers any benefits arising out of land. Then it also covers things attached to the earth or anything which is permanently fastened to anything which is attached to the earth, like any plant and machinery which is fastened to a foundation. Foundation is attached to the earth. Now, what is all covered as per the definition? Any trees and shrubs which is rooted in earth, any building which is embedded in earth, anything which is attached to the earth to enjoy the benefit of the land or the building which against which it has been attached. So this is how these laws have defined the immutable property to be. Now, this issue is not res integra. There have been disputes under pre-GST regime. There has been a lot of jurisprudences where the tests have been laid down by the courts how to determine if any property is immovable or movable. We have umpteen judgments which talk about the nature, the extent, the degree of annexation, and the intentions that have to be applied. So there is one Supreme Court ruling which says that anything which is movable without having enough damage to the property where it is attached or where it is fixed, and it can be easily dismantled and re-erected in any other location, so it is in the form of movable. We will not call it as an immovable property. Then there's another Supreme Court ruling in the case of Triveni Engineering which says that even if something can be re-erected or moved from here to there, you also have to see the intentions and the facts that why it has been fastened. So is it attached to the earth to enjoy the benefits of the immovable property? Can the property that has been attached or the machinery or anything which is attached to the earth can by itself be, the benefits can be enjoyed without the same being attached, or it is attached only for a limited purpose? So these types of tests have been laid down. And then there is also a circular which was issued by the Central Excise Department laying down the same parameters, that how anything can be defined as a movable or an immovable property. Then came another test of intention of permanent annexation, which was brought in the case of solid and correct engineering work. So this is a very specific test which has been laid down by the courts in this case, where they say that if you're annexing any equipment and that is only for the limited purpose of enjoying the benefits of that equipment per se, then even if it is fixed to the earth in such a way that when you remove it, it might, do some damage or here and there, so it will still not qualify as immovable property, because why you are attaching it is not to enjoy the benefit of the land and building. You are attaching it only to enjoy the benefit of that machinery itself. So when you affix anything with nuts and bolts, these machineries, you want to have a wobble-free use, because these are heavy machinery. When they work with a lot of vibrations. So in order to avoid those vibrations, they have been annexed or fixed with nuts and bolts to the earth. So having said that, they said that the purpose of attachment is not to enjoy the benefit of land, but to ensure that you enjoy the benefit of that particular machinery without any disruption. So this is something which came as a new principle which was laid down by the courts in this particular case. So all in all, if you see, there are twofold tests which have to be applied. One, the degree and extent of attachment. When you talk about degree and extent, we have seen where the courts have said that whether it can be easily, moved, or even if it is fixed, whether it can be just removed and moved without, creating enough damage to the property where it has been affixed. And secondly, what is the intention? Whether you want to enjoy the benefit of the property or you want to enjoy the benefit of the land against which that property has been affixed. So these two tests are something which the courts have laid down over a period of time. So friends, if you talk about the degree and extent of attachment, this is something which is an established principle even under the English law. They also recognize this kind of a principle that if anything has been fixed and attached to the earth, and if it's removed without enough damage, takes a according to that you determine whether it's movable or immovable. But the principles of intent of attachment is still evolving. This is in this solid engineering works case is for the first time we saw this kind of after Triveni we saw this kind of a principle which was laid down by the courts. But there is still a long way to go to understand the concept of intention. Where do you derive the intention from? How you derive the intention? So maybe in coming times, we'll have to wait and watch how the courts are developing the jurisprudence, how they are laying down the principles in order to determine whether anything qualifies as a movable or an immovable property. Now, with this background, We'll take up some few case studies, which are like, again, like I said, we have handpicked those topics which can be common across the industries, may not be very specific to any particular industry. We'll talk about, first of all, the construction of factory. Now, when you construct a factory, an organization, whether it is into manufacturing, whether it is into any kind of a product development kind of a activity, you are setting up the factory. You incur a lot of expenses. It starts from a pre-construction work to goes to the post-construction work. The question comes that to what extent the ITC can be availed or it is denied, because we saw the entry under section 17.5, which says that any works contract service or any ITC on goods or services which is used for the construction of immutable property other than the plant and machinery should not be allowed to the taxpayers. Now, how you determine that whether anything and everything which is going into the construction of factory should be denied as a credit, or as a taxpayer, do I still have the room to cut it down into some pieces, break it down into parts, and to see that what part of it I can take as a credit, what part of it I cannot take as a credit. So if you see the entire, the roadmap or the blueprint of any construction of any factory, it starts from a pre-construction state. You may have land which has been taken on leasehold or freehold, for which you pay lease rentals. Then you start with the civil work, starts from the buildings, the factory sheds, etc. Then there are certain plant and machineries, which can be the main machineries, movable or in the nature, and can be immovable in nature. Then there are certain equipments and all. So if I talk about the movable items, no doubt about it, there is no restriction. We can take the credits. No issues in that. Now you come to the lease rentals that you pay under the pre-construction stage. Very, very, pointed questions comes to us that whether this is also going to be denied, the credit of these lease rentals should also be denied, because this is going into the construction, because this is the base on which the construction is happening. So friends, going back to the words which are given under the law, it is very clearly mentioned that the ITC is denied only in respect of those goods and services which are going into the construction of the immutable property. The land is not constructed. You have taken it only on the lease. So therefore, any lease rental which you are paying for building the factory and all, there should not be any denial of any credit. We have not even seen any specific ruling which has come denying the credit. So with respect to lease rentals, you can very much take the credit, and there is no restriction under law which denies these kinds of credit. The post-construction part, we have seen any movable plant, machinery, computer, furniture, very well available, no issues in that. Coming to the issues or the expenses which are incurred during the construction. So within this also, there can be two parts: work, which is civil work, and work which relates to immovable plant and machinery. We have seen that civil work, no doubt about it, it is clearly outside the credit net. What is allowed is immovable plant and machinery. I think there is no doubt in this part. We all are clear with this fact that so long as there's a civil construction, the credit is not allowed. So long as there is an immovable plant and machinery, the credit is allowed, except for those three exclusions which are given under the provision of the law. Now, practically what happens is that normally people end up giving the turnkey contracts. Now, let's say you are doing this kind of a construction. You know there is one part of it for which the credit is allowed, and there are other parts of it for which the credits are not allowed. Now, how to maximize the benefits? Here comes your strategies, how you can strategize your contracts so that you get the best benefit in the entire supply chain. Now, let's say you are giving a works contract to a particular person. First, a suggestion would be, don't give the turnkey contracts for end-to-end construction. Why so? Because the minute you say that, it's a turnkey contract and everyone, the person who's giving the supply has to give, everything, and the considerations, the POs, the invoices, everything is working in a fashion that it's only one single contract. Even if there are spaces where you can take the credit, because of the kind of contract that you have issued, you may end up losing the credits. So how you can strategize these contracts, that you want to give it to someone, you want to give it to one particular contractor, break your contracts in such a way that the orders for which the credits are available should be given separately. They should be accounted for separately. The invoices for same should also be coming separately. The payments, etc., is fine separately or together. That all can be worked out. And where you are not entitled to take the credit, those contracts, those invoicing, those accounting should be kept separate. Why? Because these are the documentations which will help you to establish your case that you took one service of a particular supplier for which the in respect of which the goods the credits were available, the documents are separate, and where it was not available, the documents are separate. Another crucial thing which we have seen is that when we the taxpayers or the owners of the factories, when they have to give the civil work, so the entire building construction work as well as the foundation and support for the machinery work, again that is given to a single contractor, because when he is doing the civil work, he is using the brick and mortar, so you will want that one person only should do it without disturbing the entire structure. Now we have seen that while the credit of civil work as such, so called as building and the factory, etc., sheds, is not available, law allows us the credit for any foundation or support structure which is built for mounting any machinery or apparatus. What to do in such cases? You have to give the civil work to one person, because when he's constructing the factory, he has the blueprint, he knows what has to be done. You can't appoint, for various administrative conveniences, you don't want to appoint multiple contractors. Again, what you can do is, what you can strategize your contracts in such a way is that the contracts for the building work, the civil work, can be given separately, and the contract for the support structure, which is foundation, which is required for the plant and machinery, can be given separately. This will again help you to establish that these are two separate line of services that have been taken by the company, and for one which the credit is not allowed, the documents are separate. For one which is the credit is allowed, the documents are separate. If you have a lump sum contract or single contract, then what is going to happen? Everything falls under one ambit, and everything, the main principal supply becomes the construction of the building. So even if there are so many other aspects or various elements for which the credit is available, just because you enter into single contract, you end up losing the credits in those areas. So this is where we would want to guide you or advise our clients that strategize it in such a way that you can get the maximum credits without losing out to your the way you structure your contracts, and you end up losing the credit just because you are not aware that these kind of structurings are also possible. Now moving to the next case study, ITC on prefabricated buildings and structure. So friends, this is the new era construction strategy, or maybe construction methodology, technology that has been has evolved again over a period of time, that instead of building any building or constructing any building brick by brick using bricks and mortar, nowadays there is a prefabricated or a pre-engineered structures which are available. So for example, the walls of the room, normally conventional way or a traditional way of constructing is brick by brick construction happens of the room's walls. But now what happens is that you get the panels of these walls which are available, prefabricated, which are available in the market. And once a building has to be constructed, these panels are put together to make a wall. So again, the disputes or the discussions around the eligibility of ITC comes that whether such prefabricated structures, which per se are movable, we very well know they are moved from one place to another. Only after joining together they become immovable. Otherwise, they are movable. Whether the credits of the same can be allowed as movable property, or just because they build up into a different categorization, or the structure itself changes, whether the nature of these prefabricated structures changes from movable to immovable. Till date, we have two negative rulings under advanced ruling in the state of Haryana and in the state of West Bengal, which have clearly said that the prefabricated structures, though per se in their own characteristics they may be movable property, but the intention with which they are brought together and with which the building is constructed, the ultimate intention of the person is to enjoy the benefit of that property as a warehouse along with the land. So we saw the intention, the principle of intention that has to be applied to understand whether something is movable or immovable. So when you talk about the warehouses or any office which is constructed using these prefabricated structures, ultimate intention is to enjoy them over a period of time. There is a permanency attached to it. No doubt, someone can argue that when I remove it, if I apply the tests which are laid down by the Supreme Court in the cases where they said that if you can remove it without, enough damage to the property or the area where they have been attached, so in such cases, if I can, destruct them and reconstruct them, they still they are in the form of movable. But that is if you apply such tests, somewhere down the line, it leads to an absurdity that when I construct a warehouse, these structures, even though by nature they are immovable, they're movable. The minute they become a warehouse, they become a building. They partake the nature of immutable property. They become permanent in their sense that without having them in this form, a person cannot enjoy the benefit of that area or that warehouse or that office that has been constructed. So again, these matters are still sub judice. There is no clear cut. These are only advanced rulings. There is no clear cut answer to these kind of issues where the credits are clearly eligible or clearly not eligible. So what has to be done? No doubt, having such a negative ruling always gives you a discouragement to take the credit. But since the matter is still not settled at any court or before any judicial forum, what a person who is dealing in such a kind of expenses can do is that you can avail the credits and reverse these credits. Why we say so? That it is not a settled issue. It is not that very clearly is laid down that the credits of PES will not be allowed. The prefabricated structures will not be allowed. These are only rulings, and these are all departments' understanding. The courts have still not ventured out or dwelled into the facts of these cases. So, with such a background, if you avail the credit and reverse it, you have the opportunity to take it at a future state. Let's say tomorrow, 5 years, 6 years down the line, there is any favorable ruling. You can avail the credit. Friends, just to highlight, the timeline under section 16.4 is only applicable for the first time availment of any ITC. Wherever you avail and reverse the credit and then you're re-availing it, the timelines of the availment will not be applied. This is a settled jurisprudence under pre-GST. There was a central excise circular and there is a Allahabad High Court ruling also, which clearly says that these kind of re-availments will not be hit by the time limits prescribed under the credit law. And the same method or same ratio can be followed under the GST law as well. So with this kind of a background, what we are advising or we suggest our clients that if you have these kinds of expenses and it's a huge chunk for you, then you can avail and reverse the credit so that tomorrow, if there is any negative ruling, there is nothing to lose out because you never availed or utilized the credit. And if there is a positive ruling from the courts which is coming and gives you beneficial benefit in terms of availment of credit, then you can re-avail without any time bar, any restriction. And that is how it would help you in generating the cash flow. Another crucial aspect which is in discussion always with respect to ITCs is on the construction services which are availed by an organization which is leasing out their property. So going back to the main definition where it says that if you are taking any goods services in respect of construction of any immovable property for your own purposes, the credit should not be allowed. So friends, we have a favorable judgment in case of Safari Retreats. Odisha High Court held that wherever any assessee is leasing out the property, he is not using it for his own account. He is leasing it. Therefore, this restriction should not be applied. So very favorable judgment, no doubt about it. But again, the matter is pending before the Supreme Court. So to what extent you can completely rely on this judgment and take the credit is something has to be seen in times to come. With this, there is a negative ruling also in case of Vardhan Holidays, which has given a very contrary view to what Safari Retreats held. They have not followed Safari Retreat, and they clearly said that the term which is used own purpose doesn't mean for your own consumption. If you are building a property and you're using it for further supply, that is also own purpose. So one favorable judgment from Odisha High Court, one advanced ruling from Uttarakhand authorities, contradictory views. Of course, the high courts will have a upper, say, But nonetheless, it's a high court and the matter is still pending with Supreme Court. Any point of time, the ruling can come against or in favor of the assessee. So again, in such cases, what has to be done if you have such a credit and it's a huge credit which is lying, then applying the same logic in terms what we saw in terms of the construction of factory, wherever the credit is available, you take it, apply the same strategy. Don't get into turnkey contracts or single contract. The way you do it for the construction, break it into the pieces where you get the credit, have a separate POs, separate invoicing, separate transaction. And with respect to civil work, since Safari Retreat is allowing this credit with the parallel negative ruling and the fact that the matter is subjudiced before the Supreme Court, you can again take the credit and reverse it, so that tomorrow, if let's say before Supreme Court the matter is held in the favor of SSE, you can again reavail the credit and take the benefit. There is no time limit. And in case it is decided against the SSE, you have nothing to lose, because whatever credit you availed, you have already reversed. There will not be any interest or penalty, liabilities, etc. arising on the assessees. So these are very crucial points where, we might not know because the matters are still pending before various courts. So this is how you can strategize, so that at any point of time in future date, you can take the benefit of any beneficial ruling which is coming by the Supreme Court. Now comes very specific telecommunication towers, very specific to the telecom sector. But again, the logics or the ratios which has to be seen in these cases is something which can be applied across the industries and across various sectors. Now, when we talk about the telecom towers, there are two parts to it. One is this structure, if you can see the screen, this structure of angle, steel, etc. This is one part of it. And then you see various equipments, BTS, satellites, antennas, etc., which are mounted on these towers. So there is again a set of organization companies which provide these kind of infrastructures to the telecom companies. So huge dispute, a huge amount, around 30 to 35,000 crore of ITC blocked with these companies with respect to these kind of infrastructure support which is being given. Again, disputed, highly disputable area has always been under the pre-GST regime, and even under GST, we are not seeing any favorable ruling coming till date. Umpteen judgments which clearly say that the telecom towers are immovable property. So therefore, once they are immovable property, they fall under the restriction under Section 17(5), and the credit should not be allowed. Two contrary high courts, Bombay High Court considering them as immovable property, and Delhi High Court considering them as a movable property. So with this two contradiction, again, the assessees don't know what to do, whether credit should be taken, credit should not be taken. Another writ which is pending before the Delhi High Court in the case of Bharti Airtel, which is again a matter which is still pending for hearing. It was way back to be heard in November 2020. Till now the hearing has not happened. So this is very specific to the ITC with respect to any towers and telecom infrastructure which is being used by the telecom sector. Now again, what can be the outcome? Because all these matters are pending before the Supreme Court, the possible outcomes are only two. Either they will be treated as movable property and the ITC will be eligible, or either they will be treated as immovable property and ITC will not be eligible. Now, while these rulings are for the pre-GST era, the ratios will apply equally in case of GST era as well, the law, the way it has been worded. So if, let's say, the Supreme Court holds that these telecom towers and their infrastructure, etc., per se is not is an immovable property, the credits will not be allowed even under GST. Now, to what extent this limitation or this restriction would apply? Like we saw, there is this structure of angle and steel, the tower, and then there are equipments mounted on it. Friends, in our view, the restriction, if at all, should apply only and only to that tower if the courts, they hold that the telecom towers per se are immovable property. The position that has been taken with respect to those other equipments which have been mounted on these towers continues to remain the same, because these equipments are very much movable. They are mounted on the towers, and again, applying the test of the degree, the annexation and intention, one can simply argue and this is what the industry stand has been, that these are not immovable in nature. They are mounted only for the beneficial enjoyment of those equipments and not for the enjoyment of the land or the immovable property on which it has been mounted. Now, this is when it is not allowed. What if it is allowed as a movable property? Now, by the time these judgments come, again, we might not be in a position to take the credit. So, the same logic, the same strategy that can be applied by the people who are in this kind of a sector, and this is what the industry as a whole is also proposing to do, that they'll be taking the credits and reversing and waiting for the Supreme Court's decision. If it comes in the favor, they can reavail the credits, and it's a huge chunk. Like I said, there's around 30 to 35,000 crores of the credit which is there in accumulation, which is not being allowed to these telecom sectors. So this is something which will come as a huge boon for the sector. And if it is not allowed, assuming that the courts hold that it's an immovable property, then in that case, once again, nothing to lose. You have availed and reversed the credit. So the industry or the taxpayers will not face any rigors in terms of interest or penalty which the department would have imposed if these credits were not reversed. So again, same logic like we applied in case of construction sector, the renting sectors, and again the telecom sector. You have to be very careful depending upon the quantum of credits which is being blocked, depending upon the position that the company would want to take. We would really want to suggest that this is a huge infrastructure which is set up, and a huge amount of credit blockage happens over here. So wherever the matters are subjudized as an industry or as an organization, wherever there are conflicting judgments, or there is a room to argue, matters are pending before the courts, take the credits, reverse them, and depending upon the outcome of the higher forums, you can again reavail them. So this is something where you don't close the doors forever. You have room to take the credits once again. Moving on to the next very interesting issue is regarding the credits which are to be taken on the gifts and the sales promotion. Now, once again, if you see the law, Section 17(5)(h) clearly denies the credit of any goods, etc., which is given by way of gifts and free samples. Free samples is something which we are not discussing. We'll be focusing more on the gifts part of it. Now, if you see, what is a gift? Again, a term has not been defined. So we again borrow the definitions from Transfer of Property Act and also some dictionary meaning. So gift is something which is given voluntarily, out of love, affection, without expectation of anything in return, whether in terms of consideration in cash or in kind, or any reciprocal promise. So gift is something which has no quid pro quo. Like a consideration would have a quid pro quo, gift doesn't have a quid pro quo. So something which is given gratuitously, voluntary, forms a gift. Now, to see that anything that is given by the manufacturers or any business to anyone, be they distributor, retailers, etc., whether it falls under the definition of gift, and therefore the ITC of same should be denied, or there is some more arguments which can be put forth to take the benefits of the credit. We'll take some case studies that will be easier for all of us to understand. So many a times it is seen that there are distributors, dealers who are having arrangements with the manufacturers. They have to sell particular quantity, or they are picking up some purchase quantity, etc., etc. So sometimes there are certain cases where we have seen that the manufacturer, out of gratitude, gives them some foreign trips or any vacation. Not agreed between there is no contractual agreement with the dealers or distributors that such trips will be given, or such packages will be given to them. Maybe depending upon his performance, the way he's selling the product, the way he's lifting the quantity, the purchase quantity, voluntarily the manufacturers, they give these kind of free trips, vacations, etc. Then we have seen gifts which are linked with the targets. So if you meet certain targets, the PLB bonuses, etc., then we will give you some gifts. We'll give you iPhone, we'll give you iPad, we'll give you a scooter, we will give you a TV, etc., etc. So here there is a connect with some condition which is attached. You have to achieve something to get this. Completely, opposite situation. The first one, given without any condition, the second one given with condition. Then apart from them, there are various other scenarios that the distributor gives some poster hoardings, the advertisement material to the distributors. Then sometimes they give the promotional items like calendar, diaries, pens, etc. Then there are some buy one get one offers. So these are very common types of schemes which are floated in the market by the manufacturers for the distributors to incentivize them to get more more products being sold in the market. Now the question comes that, no doubt, if you see the larger picture, these are all promotional activities which a manufacturer does. Why would he do it? Because he wants, the more my product is sold, the more my my turnover increases, the more benefit I would get. So the question comes that, since it is in the nature of a promotional activity, whether the ITC is available for anything and everything which is given under the aegis of these schemes. So first one, when we see, we talk about the voluntary foreign trips, etc., which are given. Friends, there is a negative ruling in this case, Sarfa Courts India Private Limited. The Karnataka authorities they have very clearly mentioned that this is a free gift which is given to the distributor to incentivize them. There is, of course, since it's a voluntary, there was no condition attached, nothing was expected. Therefore, it partakes the nature of gift, and therefore the credit should not be allowed under Section 17(5)(h). Unfortunately, the advanced ruling authorities have skipped the language of the law. They haven't appreciated the language which has been used under Section 17(5)(h). If we see Section 17(5)(h), it talks only about the goods. It says if anything is given, any goods are given in the form of gifts or free samples, then it should not be allowed as a credit. There is no mention of services. So according to us, this ruling is not laying down the correct position. The restriction under 17(5)(h) is only with respect to goods. If there are any services of these kinds, let's say any vacation, any other free services, any beneficial services are given to the dealers without any condition attached to them, voluntarily given, though they are in the nature of gift, but they still don't fall under the restriction of 17(5)(h) because it is restricted only to the goods, not to the services. So the credits of these services should be allowed to the manufacturers who are providing them to the distributors. Now, another types of free of cost items we have seen. There are certain advertisement materials like brochures, the flyers, price list, means of communication, display boards, etc. These are given to the distributors and the dealers or retailers to display in their shops. And then there are some promotional items like diaries, pen, calendar, etc. Now, if we see the concept of denial of credit, the credit is denied when it is a free sample or it's a gift. No doubt, advertisement material and promotional items are not samples. These are independent of what is being independent of the main product which is given. So the question comes that whether all of them qualify as gift or not. The answer to this is that any advertisement material which is going to the distributor or the retailer, while it is free of cost, it doesn't take the nature of gift. Why? Because it has no value for that person. This person cannot use it for his own personal consumption. This is only a material which he has to display in his shop, in his retail outlet, and it's only because of the under the instruction of the manufacturer he has to follow it. He's doing it. It doesn't give him any benefit other than increasing the sale of the product. So according to our interpretation of this section, the credits in respect of these materials should be allowed. These are typically promotional items, and they don't qualify as gift because they have no economic value to the retailer or the distributor. They don't get any benefit out of these items. Once the material is, let's say there is a scheme for which a price list has been given or a brochure has been given, after a period of time, it's all gone. They don't keep it with them. It doesn't serve them any value. As against that, when you talk about the promotional item, the diaries, the pen and calendar, these are something which the distributors or retailers, they can consume themselves. They can use it for themselves. So these definitely qualify in the parameters of gift. And according to us, the credits of these items should not be available under 17(5). With respect to advertisement material, we still are of the view that the credit should be allowed. Again, friends, we have two negative rulings, BMW India and Page Industries, which have completely denied the credit. So again, the issue which boils down again for these items is that whether the advertisement materials credit should be allowed or not. According to us, the credit should be eligible, but wherever you feel like the amount is such that you don't want to risk it, apply the same strategy, take the credits and reverse them, so that in future whenever the matter is settled, you can take them back again. Now, another aspect, wherever when we talk about the advertisement material, when you are taking the credit, there is a parallel entry under Schedule 1 which talks about the permanent transfer of business assets where the ITC has been taken. Where it is gifts, the ITC is not taken, the question of team supply doesn't apply. But let's say you take the credit for the advertisement item and you are giving it free of cost to any dealer or any distributor. So whether this entry gets attracted or not, Indian law is still not settled in this, but internationally under UK VAT laws, there is a VAT notice 700/7, which has clearly mentioned that the point of sale display material items, these are not supplies, these are not given as a transfer to them. It's only for a limited purpose to do the display and the promotional activity, and therefore no VAT, etc. should be paid on this. So drawing the logic and the reasoning from there, we can also take the view that if, let's say, you take the credit and there is a dispute or anyone is disputing that because it's a transfer, the tax has to be paid as a deemed supply, a view can be taken that there is no need to pay any GST on these deemed supply, because these are not as such transfer. These are only given for a limited purpose and only as a promotional item. Another very common scheme which we have seen is buy one, get one. This is again a very settled principle. Only for the sake of discussion, we'll do it. Even under pre-GST regime, there have been rulings under sales tax Premnath Motors where it has said that nothing goes as a free of cost to anyone. So if you're giving anything free along with another thing, it is assumed that the cost of the free product has been embedded in the main product. And accordingly, you have to see whether the product, when it is going into the combination, whether it qualifies as a composite supply or a mixed supply. So in such cases where there is no need for you to reverse the ITC, the only thing that needs to be seen is that whether the final product which is going in package, whether it is a composite supply and therefore the tax rate of the principal supply has to be applied, or whether it becomes a mixed supply and thereby attracting the higher rate of the tax in the combination. So this is something which has also been clarified by the circular under GST law. And I think the law is quite settled in this, that ITC is available. The only thing that needs to be seen is whether it becomes a composite supply or a mixed supply. Following this, there is another scheme which we saw when you are given any free gifts or any free goods, any item on achievement of target. So we saw the case of the free trips which are given without any condition. But there is a case where some free gifts are given, and I'll specifically talk about the goods because the credit is denied only in case of goods. So any goods which is given on achievement of target, it has been agreed with the dealers or the distributors that once you achieve a particular target or a particular turnover has been achieved, these gifts or these benefits will be given to you. According to us, applying the same logic of buy one get one, this particular supply is not a free supply. So therefore, the reversal of IT is not required. Unfortunately, we again have negative rulings which clearly say that the credits of these goods are not to be given because these are gifts, etc. According to our view, the rulings, they have not appreciated the fact that there is a condition which is attached to these when these gifts or goods are given to the distributors. These are not voluntarily. There is a agreed agreement. It can be a verbal agreement, it can be a written agreement. Like in case of Sanofi India, the basis on which the ITC was denied was that there was no contractual obligation. But since it was not in writing, doesn't mean it wasn't there. Even if there was an understanding, a verbal understanding, and by that understanding, these obligations are being met by the manufacturers. So therefore, there is an understanding, there is an obligation under which these goods and gifts are being given on achievement or fulfilling a particular condition. Therefore, denying ITC on the fact that these are free gifts, according to us, is not correct. These are not free gifts. There is something which is expected out of it. May not be in terms of money, but in terms of increase in sale, etc. So therefore, these kinds of supplies, the ITC should be allowed. Now, once you allow the ITC, again, Schedule 1 entry gets attracted, that whether these supplies would be treated as a mixed supply or a composite supply. Yes, because these are given on achievement of target or coupled with some other products. So here it is very important for an organization to see that whatever goods you are giving in combination as a free product, if it is attracting any GST rate which is higher than the main product. Say, for example, you buy 100 quintals of atta and I will give you one iPhone. Atta may be an exempt supply, a branded product, maybe 5% or some rate. iPhone falling under 28%. So this combination, at no point of time we can argue that it's a composite supply. So ultimately it falls under the parameters of mixed supply. And this is what even the Irish law has discussed and looked into, the fact that if these kinds of a combination are going, then something which is not incidental to the main supply, which will mostly, in most cases, it would not be, this will attract the rigors of mixed supply. And what happens, that something which was being sold free of cost, without any GST, as a nil rate or maybe 5%, 12% rate, depending upon the main product, might attract rate as high as 28%, depending upon the free gift which is being given along with that main product. So now what the companies can do in such cases? One option is that if the quantum is very less, or you don't want to get into the contradiction of mixed supplies, one advice is that don't take the ITC, because Schedule 1 entry gets attracted only when you have taken the ITC. If you don't take the ITC, then the particular entry of permanent disposal, which is deemed a supply, will not get attracted. Now, other thing what companies can do, they don't want to lose on the ITC, then maybe you can bring up schemes in such a way that the product which you are giving at a free cost, as a free gift to these distributors and retailers on achievement of target, in those cases, you can pick and choose those products which are equivalent or having a less GST rate as compared to your main product. So that if it's an equal rate, even if it is mixed supply, same rate will be applied. If it is at a lower rate, the value remains the same, because the product is not, when you are giving the product, you are not charging anything specifically. The value is already recovered under the main product. So ultimately, you don't end up paying extra taxes on the combination. So these are the options which are available with the manufacturers, the way which they can, strategize and make up their schemes. So people who are dealing in such kind of schemes or giving such kind of incentives, they have to be very careful when they're devising such schemes. They have to be very careful in terms of the language which has to be used in the scheme. So these are things which will, when taken up by the department, can settle the case in your favor or or against you. So very carefully you have to devise a scheme so that you don't fall under the bracket of mixed supply and end up paying taxes at a higher rate. And trust me, most of us don't even know that when such schemes are being floated, there is an exposure of mixed supply which may happen, because we are simply taking the credit without even looking into the Schedule 1 entry. So maybe after this discussion, if some insights which have been given during the discussion, you may go back and look into the schemes that you are being floating, and where do you see an exposure, whether ITC should be taken, or if you want to take the ITC, whether it should fall under mixed supply, and what are the rates, etc., which are applied. So something which has to be seen very carefully depending upon the language that has been implemented. Now coming to the very last segment, again, very, common topic, which is again discussed amongst the organizations and the taxpayers, that when they are incurring any expenses for the employee benefits, to what extent the ITC is allowed? Because again, there are restrictions, there are laws where Leo? Okay, there was some disruption. Sorry. So there are restrictions which are there under the law, which might deny you the credit. So let's see what are those restrictions, what are the types of benefits which are commonly given, and by and large, most of the industries are, still struggling to decide whether the credit should be available or not. When you are giving uniforms, gloves, helmets, safety shoes, office laptop, these are very common, products which are given by the organization to their employees, which is to be used. Again, these are given free of cost. Employees are not charged for the laptops, they are not charged for the uniforms, they are not charged for the safety shoe. So whether it qualifies as the gift, therefore credit should be allowed. Whether because it is for the personal consumption, the credit should be disallowed. How it has to be seen. Another important or very common expenditure which is incurred by the organization is towards the hotel and travel expenses when you are going for the business travel. Any sales team which is traveling across the locations for doing the advertisements, sales, promotion activities, or employees going to different locations for any kind of a support. So whether the credits on these hotels and travel expenses should be allowed or not. And last one, very important, food and beverages, canteen services, free tea, free coffee, etc. Very most commonly incurred expenses by an organization, whether the credit should be allowed or not. First of all, we'll see what are the clauses under which the restrictions prevail. 17(5)(b)(1) it disallows you to take the credit of any food and beverage or any outdoor catering unless until it has been mandated under the law. So like factories and all, they are mandated to have canteens. So whether in all cases the credit should be allowed or not, we'll see in the subsequent slides. 17(5)(g) disallows you the credit in case anything is used for the personal consumption. We'll see to what extent the personal consumption has to be applied. Then 17(5)(h), where the goods are lost, destroyed, again written off, etc. by way of gift. So when these uniforms, etc. are given, or any free food, etc. is given, whether these are gifts or not, we'll see that. To start with the very first case study where we saw that uniforms, gloves, helmets, etc. are given. Friends, these items are given to the employees only and only for the purpose of to be used during their office hours, for their safety purposes, and is given because they are in their employment. These products serve no utility or no benefit to these employees once they are out. So no one would want to roam around in a uniform or a safety shoe or helmets. In many cases, safety shoes and helmets are even kept in the factory premises. They are not even allowed to take them out. Office laptop, very common expense which all the organizations today they are incurring. Whether the credit should be allowed, should not be allowed, office laptop is taken by the employees. Now when you see the two restrictions, the first one, when it talks about the personal consumption, friends, the interpretation of this clause is not to be seen qua the person who's consuming. It has to be seen qua the taxpayer who is taking the credit. So any expenses which is incurred by the taxpayer and which is personally consumed by him. For example, the owner of a company, the sole proprietor for that matter, he is doing a personal travel. He's going on vacation. These types of travel expenses will not be allowed because he is consuming them for his personal leisure and has nothing to do with the business expenditure. And at the same time, when the same person is traveling for any business expenses, for any business meetings, etc., the credit should be allowed. Because then it is not for his personal consumption. He is doing it for the purpose of business. So 17(5)(g) restriction has to be read very strictly. The term personal consumption is not to be used because most of the time any goods and service is consumed by anyone, any person. So if you start reading personal consumption with respect to anyone and everyone, then no credits would be allowed. So this has to be seen that whether the taxpayer to whom the credit has been given, is he using it for his personal benefits or is he using it for the business purpose? Just like your income tax expenditures, any personal expenditures are not allowed, but any business expenditures are allowed. So same logic has to be applied under section 17(5)(g) also. Now coming to the second restriction, okay, fine, it is not a personal consumption, but because it is given free of cost, whether it is a gift, the uniforms, the laptop and all, once again, these are given only to those people who are employees of the organization. Had they not been in the employment relationship with the organization, these products would not be given to them, be it uniform, be it gloves, be it office laptop. Therefore, again, these are not as such they cannot fall under the voluntarily or gratuitously being given. They are given because there is a requirement that in order to serve their employment, these products are necessary. The laptop, without laptop, the employee cannot work. So these cannot be qualified as gift. And once, in most of the organization, for that matter, every organization, once the person leaves the organization, this laptop has to be given back. It is not retained by them. So therefore, another reason that it doesn't qualify as gift, because they cannot take it away with them. So according to this, these products doesn't call under either under personal consumption restriction or as gift. Therefore, the credit should be allowed in these cases. Second expenses, the hotel travel again. If it's a business travel, be it airfare, be it rail fare, be it hotel charges and all, the credit should be allowed. There should not be, if it's going for a business purpose, a person is traveling for a business purpose, the credit should be allowed. Any personal person, like a deep travel, or any owner or director of the company is going for, these cases may mostly, arise in case of sole proprietor. So any person who is, using it for his own personal consumption, leisure and all. So those credits should not be allowed, but any business related expenses should be allowed as a credit. Keep in mind, for the hotel bills, you have to be very careful that when you are taking the bills, the hotels will charge the place of supply of their states. So while taking credit, you have to be very careful that in which state the credit is being taken. Otherwise, because of the PO, if you are sitting in Delhi and the employee has taken the hotel services in Maharashtra, even if there is no restriction under the ITC law, because of the POS being of other state, the credits won't be allowed. With respect to food, we have already seen there is a clear-cut restriction, because giving food for travel and all, there is no statutory requirement that it has to be provided. Therefore, the food credit should not be allowed. And last one, very favorite topic of every organization, that when we provide canteen facilities and all, whether the credit should be allowed or not. Friends, the canteen services where the employers are recovering any amount from the employees, it qualifies as a deemed supply under Schedule 1, because there is a service, not Schedule 1, as a supply under the definition of business, because this is something which is incidental to the main business. And since the organization is recovering some amount, this qualifies as a service. By nature itself, these services qualify as canteen service, which are taxable at 5%. And the canteen services taxable at 5%, in the rate notification itself, the ITC is not allowed. Therefore, wherever any employer is recovering any amount from their employees, the ITC will not be allowed. Coming to the second part of it, giving free, coffees and all that, free canteen facilities. Again, the credit should not be allowed unless and until same is mandated under any law. So, for example, any factory acts or any labor laws which require that you need to give the, refreshments, you have to have this much amount. And if you're not recovering anything, so once you're not recovering anything, it's not a supply. We don't even qualify them as a deemed supply, because this is not given voluntarily. This is because given only to the employees in the course of their employment. Therefore, doesn't even qualify as deemed supply. But unless until this is mandated under the law, Section 17(5) restricts the credit of these items as well. So please be very careful when you are taking the ITCs of these products. You have to see very minutely what all restrictions are applicable on all these benefits when you are giving to your employees. With this, I end up my presentation, and we can take up the question answers.
Well, thank you. Thanks a lot, ma'am, for this insightful presentation. I'm sure this will add to our knowledge on the topic. We appreciate the time you took to prepare the subject matter for the webinar and precisely explained it to our audiences. I also wish to thank all the participants for being so cooperative. Thank you all for taking time out of your busy schedule and joining us in this session to make it a success. Ma'am, are you going to take queries right now?
You tell me what is what is our schedule. If we can take it right away, we can take some questions if we are not falling short of time.
Well, I think we just might have to wrap it up. Although for all the queries that are going to be raised during the session, you might send it in writing to us at sales@taxman.com. So we can address all the queries over there.
That should be fine. So we can answer each one of your queries. So you can send it across to
please send them in writing at sales@taxman.com, and we will address all of your queries. Okay. So I guess that's all we had for this evening. Thank you all once again. We shall soon be back with another vital topic. Till then, have a great time.
Thank you, everyone. Stay safe, please.
Yes, stay safe, please. Thank you.